Hello, everybody. Welcome to our weekly or bi-weekly webinar. And today we have Erik Conrad from InCommercial. Erik is maybe the smartest guy in this business. He should amaze us today with his discussion on, I believe you're going to talk about Motor Fuels 3 and how it can be used in potentially instead of a 1031 exchange. Erik, I'm going to turn it over to you. Let's wow us here.
Yeah, thank you, Mark. High praise. I was trying to encourage you earlier to set the bar as low as possible, but as we've talked to a lot of people in the industry, if you hear something, the way you get smarter is by doing a lot of things wrong. So I've done plenty of things wrong and been told as much. So if I do some things wrong today, please, everybody, don't hold back. I'm a big boy, I can take it. I have thick skin, and we always want to do better. And that's really the only promise we make. To that end, right, what we're talking about is InCommercial's Motor Fuel Fund 3, our third such offering in this strategy with gas stations and retail motor fuel outlets. It is a 506C, which allows for general solicitation. Everyone needs to be an accredited investor in order to invest, and you need to invest through a licensed advisor. It is for educational purposes. I can't give you tax advice or legal advice. You should seek someone who actually is licensed to do that, who is familiar with your own facts and circumstances, but we can talk in generalities. If there's Q&A and other questions, please use either the chat, the Q&A, or whatever is live. So that we can answer to the entire group as much as possible. We will try to answer, or I will try and answer in as much detail as possible, but a lot of these things all need to be vetted with either yours or your client's CPA to make sure it's appropriate for them. I am going to share a presentation because it keeps me on task. Otherwise, I go on tangents and start talking to you about my kids and everything else. So bear with me a second. I will share the screen and turn off mine so you don't have to look at me. Share here. I also try and tell jokes. Feel free to laugh to yourselves. Video. It's InCommercial Motor Fuel Fund 3, as we kind of discussed. Obviously, everything has risks involved in any investment activity. You should carefully review these risks, which are more fully detailed within the offering documents and the PPM. We seek to find risk-adjusted returns that are compelling within this fund. And so we'll go through how we do that, but it is important to understand that we're looking to mitigate risks as much as possible, but we're not afraid to take risks within the fund. We're trying to take risks because that's how we make money. The equity offering amount here is $50 million. We intend to combine that with debt so that we're looking at buying $150 million or so in gas station properties. So retail motor fuel outlets. They are gas stations and C-stores. We're calling them retail motor fuel outlets throughout the offering and throughout the webinar because we want to direct you. And when people go and they Google it, they're going to find some of the IRS tax codes and some of the other things that we talk about. So they understand what the strategy is from a legal and tax perspective, in addition to just kind of the real world going out and buying a commoditized property. So our strategies, which we always try and have. I mean, we obviously want to do everything just like everyone else, but we are looking for tax efficiency, income, and growth. When we rank order them, we're looking for growth and then tax efficiency and income. That matters when we have a lot of different investors and we're trying to manage everybody's expectations. We are looking for a total return strategy. We are trying to drive returns to significant kind of opportunistic level returns, but mitigate those risks back to kind of a more core plus strategy that will make sense to most of the people on the call, hopefully. Our hold period is only 4 to 6 years because we're making most of the value in these properties upon acquisition and the way we source them, find the properties, and create that net leased income driver for investors. And then we're seasoning them over the course of a few years. We'll go into that a little bit more on later slides. Again, investment objectives, just to put these through. The funds that we run are annual funds. So our objective is to raise the money and deploy all the capital this year. That is because the way the bonus depreciation and tax losses, passive losses that we generate within this fund are calendar based. So again, we'll get to this in more slides, but one of the key objectives within the fund is that for every hypothetical $100,000 investment, we're projecting about $170,000 passive loss to the investor, which hopefully they're taking against ordinary income taxes and significantly diluting their actual after-tax investment basis, right? So stated another way, right, we're trying to get rid of that denominator so that those returns on an after-tax basis are significantly higher. Because that's done on a calendar basis, because of the way that depreciation works, we really want all of the investors to be similarly situated. So we don't want to have investments that carry over into 2025. We want everyone to be under the same tax code because it does change from year to year, and all have the same, effective net basis. So hopefully that makes sense. Again, if there's questions, if I'm talking too fast, feel free to use that chat function. One of the first questions that we do receive are going to be about, what about electric vehicles? How is this going to be, impacted over the next 50, 60 years? And, our general answer is the gas cars, internal combustion engine cars are not going anywhere for a very long time. And for anybody who doesn't believe that, you need only rent an electric vehicle. I know Mark has an electric vehicle, and so I'm sure he loves it and thinks it's great. He probably has a gas-powered vehicle somewhere else, or a friend who can come pick him up while it's charging. The amount of network and infrastructure you need to support an electric vehicle is a great indication of how many gas stations you actually need in terms of being able to adequately support our infrastructure. We still have some 97% of all cars sold require gasoline engines. That number, although the electric, and you can see on the chart, the electric vehicle sales are increasing dramatically. That doesn't change the fact that you still have these very durable vehicles that are going to be on the road for a very long time, still filling up gas. And as with everything else, all of these numbers can change, and they can change in any direction, right? So we've seen obviously a huge, even though despite the massive amount of money being poured into electric vehicles and the infrastructure to go along with electric vehicles and the incentives to consumers, you've seen consumers pull back on electric vehicles over the last couple of years. Manufacturers pull back over the last couple of years. So it is somewhat uncertain that we are going to be that. Obviously, if we move to hydrogen fuels or something like that, then it's a totally different technology, and those involve tanks in the ground as well, which is certainly what the gas station and the operators are used to. When we think about these types of business and industries, we're thinking about this from a traditional retail perspective. The gasoline is a commodity-based business that you're going to need regardless of whether it's a recession or whatever else is going on, and that's going to get you to stop. And so when it really is the driver of the C-store and that small convenience store business. And if you think about how many businesses are out there right now that are trying to be heard, that are trying to sell their product, and they're all putting money into social media and going on Amazon and being lost in the sea of these, duopoly essentially online of the very large retailers that have their own brand like Walmart and Amazon. Kohl's has some pretty strong online presence as well. You have these very large operators that control that distribution channel. It is not the democratized ability to actually move your product the way it was billed to be. And one of the few places where you actually can stand out is getting on a shelf at a C-store, where you're going to come into the store. It's 2,000 square feet. You can see every shelf item on there. There's a lot of ways for those convenience stores to make money, some of which is just simply selling shelf space to people who want, a competitor to Monster, right? Monster spends all of their money on the energy drinks. We go out and we get, Mark's hard cider, whatever, Mark wants to sell, and we put it next to Monster. We sell it for $1 less. We're going to move a lot of that product for him, and he's going to pay us for that shelf space. So there's a lot of ways to drive profits and revenues through the convenience store that people are going to stop at because they still need gasoline. We talk about due diligence. We're certainly not perfect. Mark can share plenty of stories, I'm sure. But we do research the tenant and background checks on the tenant. We do research the property, the market, the value, industry reports, letters of reference, whatever we can to make sure that we have a property that makes sense and can support the rent, as well as a credit-worthy, viable tenant. And their character, right? Who is going to actually operate, even if it's hard sometimes, so that we can protect that income stream. you also have environmental risks and other things that we're getting very good at understanding and how to trap in terms of the environmental disclosures, the state DNRs, and working with them. And then we have a layer of insurance policies, both at the tenant level. And I think where you're seeing a lot more interest in retail investment in these more environmentally sensitive businesses is because the regulations around them have become significantly stronger. 40 or 50 years ago, if you had a leak at a gas station, it was accepted practice to dig a hole, put P-rock in it, and throw the oil there and let the ground take care of it itself. That is not what happens now. You have tanks that sit in concrete pits, and the tanks themselves have two walls. Most people don't understand why there's a double-walled tank. The reason there's a double-walled tank is while you do actually have leak detection within each layer of that tank, you also have a monitor in the interstitial space of the tank. So if there's fluid in there, something's wrong, and you need to go and check it out. And so the environmental exposure that comes from these is just significantly less. Insurance is far more available. It's really been a good thing for the industry, for investors, for everybody else to really control that risk much better. The sale leaseback process, right? And so when we think about these and the value creation, we're trying to buy a retail site, right? We're trying to buy this retail site that can do a certain amount of income. When you're thinking about a retailer and how much that property value is worth and the improvement value that's worth there, we really try to acquire these as though we were the operator, it had to be the operator, and what was it going to be there. And then we have an additional layer of value which comes from the lease and finding either one of our own operators, controlling them and doing kind of asset management of that, making sure they're doing the right things, but bringing in that new lease to create an income stream that protects the value of that real estate as well. So we end up, again, when you create that net leased property, which is what we've been doing for such a long time, that value is both the property and the lease and the income and that credit. We layer them together, and that's how we create the majority of value within these funds. So as a general rule within the pipeline, we're looking at, we don't really buy on cap rates, but we're buying at 8.5 cap kind of ranges. And I don't know how much everyone's familiarity is with cap rates, but that's the yield on your actual purchase price. If you paid $1 million, that 8.5 cap is $85,000 of net income that you should expect to receive. Obviously, in low interest rate environments, that's why those cap rates become much more compressed, because you can borrow at 3 or 4%, and the tenant is paying you 8.5. We really like this strategy in this marketplace because this is a form of financing to these tenants and their expansion. And so as interest rates maintain a higher level, we're able to demand a higher rent factor for these properties. And then we collect the benefit, assuming that interest rates fall in the future. We are looking at a lot of these right now, and a lot of the appraisals that we get in and the valuations in the marketplace are still at that lower level. It's a separate podcast topic in terms of why cap rates in this marketplace haven't shifted all that much. And the highlights, at least for my framework, is that if the Fed is still targeting 2%, then that's what a lot of long-term investors are still expecting. So they're hanging on to that future curve. And that's why cap rates have not moved as much as what you might expect just from a 550 basis point move in the Fed policy. But there's some significant cap rate arbitrage, buy low, sell high. It all sounds very simple. In practice, it certainly takes some work in understanding what low and what high is, and how long can you maintain it, borrow against it, and actually have a significant runway to do it. So our runway as we do this is to acquire the properties this year. We solidify the gains. We monitor the properties and the financials for the tenants very closely and build that track record for them, because it makes them much more financeable in the future. And then as interest rates start to fall, then we either reduce our interest rates within the fund, which increases obviously our cash flow significantly, but it also allows us to put on more permanent and presumably assumable financing, so we can kind of move it through different structures. And this is one where a lot of this is dependent on our ability to pass through the tax losses that we'll talk about on the next slide in terms of how we get that 1.7 roughly multiple of your equity investment as a passive loss. But we want to pass that through while the structure is a limited partnership and has a K1, so you can just copy that information over to your personal returns. Once we do that, we believe one of our potential strategies, ones that we're looking at and very interested in pursuing, would be a conversion of that limited partnership into what's called a Delaware statutory trust. If there's anybody on the call that's not familiar with it, which we also sponsor, which is the key to that interest is that you would then report those that investment on your Schedule E directly without a K-1. Once we do that for a year or two, you're then able, if we sell the property and go full cycle, you're able to do a 1031 exchange in the future, thus avoiding the recapture. Because when we buy these properties and we go through, the next slide, I should put these slides in the other order, but when we go through that, we want to solidify those tax gains as well. So that's what that strategy is for. The whole strategy we expect to take 4 to 5 years. That's why the fund life is that 4 to 6 year period. With an exit with hopefully significant growth within the portfolio and a very efficient on a tax basis. Everyone wants to know how on earth can you get a tax loss that's greater than your investment? You have to have at-risk basis. This is you're picking it up from debt, right? So you depreciate an asset, not your down payment. So I think with most people, certainly the investors in the fund are going to own their home. They understand if they paid $500,000 for their home or whatever the cost of their home was, they didn't come to the closing table with $500,000 of their own cash. They came with 20%, 10%, 5, 40, whatever the ratio is. They came with a down payment. A lender came in with the rest. In this case, we're doing the same thing. We're coming in with investor capital. We do have a 5% equity co-investment commitment within the fund for ourselves. We're usually a little bit higher than that. We obviously like the tax benefits as well. And we use that investor capital, we combine it with qualified non-recourse debt to create the additional basis. So we're buying more property than our down payment. And that's what this graphic is attempting to show, is that when you think about that thatched line, that's actually the depreciation you're taking, which is 60% of the non-land portion, and then your 33% equity portion. It's the ratio of that, essentially 57% of the property is a tax loss versus the 33%, that's the down payment, creating those loss multiples within the fund. Obviously, the final numbers will depend on what we buy, what the ultimate leverage is, but that's where the target is today. This is all passive, and so I'm not sure how many other slides I have on here, but the passive investments are going to show up if you have particularly ongoing passive income. The investor will see the 8582. It will show on line 3. If there's a positive number there, then you have passive income that this would be able to just naturally offset. And so that's true for capital gains taxes from a passive investment. That's true for ordinary income, rental real estate, and other income that you might have that isn't otherwise sheltered by some other depreciation within your portfolio. It's also true, when we get into a little bit more exciting opportunities, is business owners and things who are doing an installment sale, maybe where second and third years would be treated as passive, or have turned over control to an heir or something most commonly, and now the original founder is now passive in the business and collecting passive income. There's a number of ways to use it. There's probably as many ways to use it as there are investors out there. Again, this requires some significant consultation with your CPA, and it's very facts and circumstances based. We certainly know there are investors who are real estate professionals who are able to take this against other real estate professional income, depending on how they've aggregated. Again, very facts and circumstances based analysis that requires consultation with the CPA. But if you give them the basic information, most CPAs are familiar with the passive and the depreciation rules. It is from rental real estate, so that's usually the other keyword that they have. And then the other part, as people, little knowledge is always a dangerous thing. It is because gas stations, and the reason we're able to do this is because gas stations are considered a 15-year asset. Gas stations and car washes are considered 15-year assets where you can apply the whole building as though it's all equipment. And so that's where that retail motor fuel outlet comes from. That's the definition of the IRS. The rule that we typically fall under is that 50% of the revenue from the site is from the sale of petroleum products. People try and get clever with that and say, can you do a tire center? Because those are petroleum-based products. I'm unaware of any case law that says anybody's gotten away with that, but by all means, if somebody wants to try it, they can go be the first. But the gas stations, there's a fair amount of case law and support out there for following that rule and the sale of gasoline and gasoline products, diesel, et cetera. And so once you sell that and you're a 15-year asset under the Tax Cut and Jobs Act of 2017, which allowed for bonus depreciation, this year it's 60% of the bonus depreciation. So the whole asset other than land is eligible when it's a gas station. 60% of that in the current rules, bonus depreciation, section 168, a lot of sub-paragraphs. There is some chance, and there's some legislation pending, we get asked about this constantly, about moving that 60% back up to 100, what impact that would have. We're projecting that 1.7 loss multiple. That's based on current tax code. There is pending legislation. It has passed the House by a significantly wide margin. It has not been scheduled for a vote in the Senate. Obviously, they've not been sent to the president's desk. That would extend it back to 100%. That would create a loss multiple using the same scenarios of about 2.8, which would be obviously crazy efficient for most investors, regardless of their tax rate. But that's not the current tax code. It may happen again at some point, either now or in the future. We're monitoring it and we'll communicate as we know more information on it. But this is a investment that we are raising money and deploying capital, managing our pipeline consistently throughout. And so we do want to encourage investors to invest early once they've made the decision. They can always invest more later. We're happy with that. We really don't want investors to wait until the fourth quarter. We understand that they don't necessarily know what their tax implications are until then, but most of our ideal investors are going to have regular, ongoing passive income, obviously high net worth investors and accredited investors. And so we've created an incentive to give those investors some of that, right? So you get a little bit of an incentive for the first quarter, a little bit less in the second quarter, a little less in the third, and then there's no incentive for the fourth quarter. We will likely not be taking investments much past mid-November anyway. So you certainly, if you're not ready to do it now or in the summer, you want to get in on the third quarter. You're not going to have a whole lot of time in the fourth quarter. It's just too hard to do the due diligence, put the leases in place, and actually execute on the business plan when it comes that late in the year. And there's a lot more competition out there for funds, because if you're thinking, oh, well, I'll wait until December and that's when I'll make this decision, just keep in mind that everyone's thinking the same way, right? And so it becomes a very active December in this industry. So our prior performance, and not all of these are gas stations. In fact, none of these are full cycle or gas stations. You can see we just started doing those towards the bottom of this list. A lot of our funds are sale leaseback transactions, dollar stores. There's some childcare centers, cookie cutter stuff that for the most part sends out dividends and works as anticipated. We're very happy with our full cycle IRR of 17.1% on a very simple average. We did dollar weighted, but it's about the same regardless of how you calculate it. Those are over a significant time period. When we construct those returns, when people think about how we get those returns, it's usually that 5 to 6, 7% cash on cash return, cash flow during the time frame, which might be lower at first, like we had talked about for this fund, and then higher as we're able to take advantage of lease bumps and declining interest rates as we go forward. And then you pick up another 5 to 6% kind of every year by reducing debt and paying down principal on your just natural loan structure. And then if you can get a accretive exit and sell it for a little bit more at the end, that's how you get your other 5%. And so it's all just a method of building the blocks one on top of each other as we go through and manage these. Have a very experienced team. This isn't everybody. I think there's about 27 employees at this point, a lot of property managers, a lot of accounting to help, several acquisitions teams and asset managers that go around and keep us honest, keep us straight, and stay on top of all of the tenants and look for those opportunities to create value. Because it's on a lot of these deals, there's not a ton to do with net lease. There shouldn't be, and most landlords believe the answer is, well, there's nothing to do. There's not nothing to do, right? There's always an opportunity to squeeze a couple extra dollars, either more value for the tenant or more value for the landlord. At the end of the day, it all ends up coming back to the landlord in the asset price and the value, lease renewal rates, all that kind of fun stuff. So, if there's an opportunity to, get, sewer improvements and other types of sidewalk improvements, access roads. I mean, just really having that tenant understanding, that retail understanding, so that our tenant is healthier at that location, the site is better. Free money is always great. We love grants. We're doing a deal now with some of our gas stations where we're getting $5 million in grants from the state of Iowa for installing new tanks and upgrading dispensers and equipment at the properties that most people don't know are out there and don't bother applying for. So very high success rates in getting those grants, but you have to do the work. So executive summary, we do have a 9% preferred return that accumulates and then pays out later, after which there's a 30% GP promote. That's where we make most of our money. There are a variety of other fees, and you can read through the PPM to get those. And that is the conclusion of my presentation. Happy to have questions. In fact, strongly prefer questions, because if you don't ask any questions, then I assume I talk too fast and nobody knows what I'm talking about. So,
Hey, thanks for this, Eric. You shouldn't be mocking my electric vehicle. So I only have 3. I do have a gas car, but it belongs to my kid now.
Everybody who has an electric vehicle has multiple vehicles, as far as I'm aware. And that's because they're kind of toys. They're real fun. Real fun.
You know what they're great for is they're like electric golf carts.
Really fast golf carts. Yes. Yes.
Yeah. Yes. But I do like them. But I do see your point about the gas stations, because Electrify America, I think Volkswagen's charging station outlet has been very disappointing. It amazes me how many times you go to an Electrify America and they'll have 4 pumps and 2 of them are down. So you can only charge at 2, and you have like a backup of 3 cars, and the average time probably 30 minutes to charge. So you end up waiting significant time to charge a vehicle. It is a problem.
Yeah, I rent them, and you need them everywhere. And we've got the app. If you're in LA, for anybody who's in LA, there's a couple of different apps that you can use, and they're intelligent. You know when somebody's there and using it, and so you know what's open, and you can drive to the right supercharging station. You don't want most of the other charging stations; those are a waste of time. And then you still have to sit there for about 30 minutes. You have to plan on it. Range anxiety is definitely real if you've got meetings or a time schedule to go to. Often at rental car places, it is a cheaper option. So if you're not driving much, it's great. My wife and I went out to Willamette Valley, and we're like, well, there's, the hotel has a charging station. So we accepted one when we went out there. It was a bit of a disaster. We try and find some places to go park it and then go to dinner and come back out. And you've picked up, 7 miles of range. And we're like, well, that'll get me back to the hotel. I don't know how to get to the airport tomorrow, but I guess we'll figure that out later. So it's just all of those things, no doubt, will get fixed at some point. But it's a bumpy road, right? And well beyond our investment horizon. So
yeah, I would agree with that. You mentioned the potential for bonus depreciation to go to 100%. What are the chances of that, and when do you think we'll know?
It's a good question. So it passed the House in, I think, January 31st. I'm going to miss the numbers, but it's close enough. It was like 370 to 70. So it's the only thing they can agree on. It has not come up for vote in the Senate, although it would presumably pass very easily if it did. But it's been, the longer it sits, the less likely it seems like it will pass, at least without amendments. They have started talking about it again. There's a little bit of horse trading going on between another bill that the Senate has passed that the House hasn't taken up, both of which sound like they're popular. So they're trying to kind of tie them together to see how they can all get what they want. But they're playing politics. At some point, it'll be worthwhile for them to pass it. If anybody wants to look it up, I think it's Tax Relief for American Families Act of 2024. As drafted, it extends bonus depreciation to 100% retroactively to January 1st of 2023, and then carries it through 2026. It would seem that the longer that lasts, the less retroactive it would be. They routinely make them. When it was passed in 2017, it was passed in December of 2017 after any news cycle and everybody was gone, and it was sort of passed kind of on vacation. But it was retroactive at that point to the beginning of 2017, which is pretty typical because people file their taxes after that. So I would expect that we probably have a 70% likelihood of it happening. Some degree of possibility that it happens after the election in a lame duck session. It is included with a bunch of child care tax credits. There is the National Bureau of Economic Research recently did a paper on 2017 tax cuts and comparing what they were supposed to do versus what they were billed as. Obviously, all tax cuts are billed as paying for themselves. You don't have to worry about it because they're going to generate so much stimulus. And at least according to that research paper, which I'm happy to share, although I think it's 400 and some odd pages, was the only tax cut that actually lives up to its billing and pays for itself and stimulates investment are these extensions of the bonus depreciation. That legitimately changes investor behavior. They invest in more durable goods and long-term assets and do pay for themselves. Just about every other tax cut falls short. So.
Hey, one more question. Notice on your slide, you're still showing Q1. We're now in Q2, I believe. That 6%, is that basically a 6% gross up for somebody investing? So
6% gross up. So it's a larger share of the economics within the fund as well as a larger share of the tax losses. So you want me to update my slides already? 2 weeks.
Well, if somebody's putting in 100 grand, they're basically getting about 106 in.
Look at 106, which is not only a higher share of the economics, it's not only would give you a slightly larger ratio of your tax losses, but I think the most material thing is it does reduce your fees pretty significantly on the promote because we have to return your preferred return of 9% on that 106 basis. Plus, we have to return all of that capital up to 106 before our fees and share would go in. So it's a significant reduction in our fees as well as extra returns for the investors.
Okay. Anybody out here have any questions? I don't see anything in the chat box. Anybody want to jump in and ask anything at this point? Looks like you did a great job, Eric. Nobody's asking any questions.
Well done.
So
Rosemary went off mute, so I was hoping Rosemary was going to ask me a question. So maybe it was an accident. She was looking for the leave button. So.
Okay. Well, I appreciate everybody joining us today, and I appreciate your time, Eric.
Thanks, Mark.
I really like this. I have personally put money in Motor Fuels 1, and I have clients in Motor Fuels 2. And I think it's been a great opportunity for people to potentially do this without having to do a 1031 exchange. In this current environment with interest rates being high, it sometimes can be difficult to find an exchange property, and something like this can be used as a passive depreciation against a passive gain. So if somebody had a 1031, they potentially could use this to mitigate their capital gains on a sale of a property. No comment on that, Eric? You're kind of looking at it like.
I agree. I'm waiting for the questions. No, you're right. I mean, the investment gain from our perspective, I think, again, a lot of people don't think about depreciation quite as naturally, but the beauty of real estate generally and why real estate, when people compare returns in real estate versus other investment vehicles, the after tax really is important. The depreciation in real estate is like if you bought Apple stock, but but you were able to offset, not only not pay the taxes until you sell it and not recognize it, but you were able to take your investment and just take a little piece of it against your income every year. And that's what you get to do in real estate. When you do a 1031 exchange, you carry over that basis. When you do this, you're buying a new asset and cramming the basis down, but they do the same thing. They offset each other just fine. Obviously, you'd rather do it against ordinary income than long-term capital gains. But in either case, you're getting an interest-free loan from the government that hopefully you pay back at a discount. With our structure, hopefully you never pay back. Hopefully you go right from this into a 1031 exchange and other tax-efficient vehicles, which, I mean, I think as everyone on this call hopefully knows and understands or will know and be able to see, the dilution of that capital is what keeps you from being wealthy, right? Everyone's goal should be, in my mind anyways, that your investments and your assets should pay your income and should pay for your life. And rich is not a number. Rich is a freedom where your investments are outpacing what you can do working every day. And you get there exponentially faster if you pay attention to tax consequences and not diluting that bucket on that's working for you, right? So,
are you able to use this against the active income? I assume a real estate professional could potentially do that, but
it's facts and circumstances based, right? And so we're a limited partnership, so there's a presumption of passive activity going on, which we're most appropriate for most investors to be in there. Real estate investors can hurdle, but real estate is also presumed passive for most investors, unless you're a real estate professional, then you get over the presumption and you can make your own designations. You have to then prove those up, document that you both are a real estate professional and you have some active activity, or you aggregate them together. So there's a number of consequences that the investor should at least discuss with their CPA. We're happy to get on the phone on that call as well and answer any questions about the fund and how it works, how the K1s work. We've got sample K1s. And we'll have our CPA available to them as well to kind of go through those questions. So, I mean, I guess the answer is in some cases, it's not impossible, right? But most investors are going to have plenty of passive income anyway if they're real estate investors.
Okay. I am putting up my email address, so if anybody wants some additional information on this, you can reach out. Would like to follow up with anybody who is interested. I appreciate your time, Erik, and I'll let you go. 38 minutes. I think that's pretty good.
Yeah, I talk fast. It's all simple. I just saw Joanne jumped on the call. Maybe Joanne has a question. No? For anybody who doesn't know, Joanne's the gatekeeper. She tries to keep me in line. She probably dialed in to make sure I didn't screw anything up. So if you need anything, you can reach out to Mark, or if you need anything from us. So
looks like she decided to have done the job. Plus, you didn't talk about the kids. I appreciate that, because you got 5 of them, and that could be a long-winded conversation. But
well, that's why I can't use the electric vehicle. No room in the electric car for that. So,
well, I have a Rivian and it has 7 passenger capacity, so you could potentially. But
will you take them?
Can you what?
Can you take them? Can I just send them over to you? Will you come pick them up? Go play with them.
My wife would probably be happy. You don't want them. Look at my kid. He turned out pretty well only because he hangs out with his mom. But hey, I appreciate everybody being on here, and feel free to reach out if you have any questions, and we'll go from there. Thanks for your time today.
Thanks, everybody.